Florida's housing market isn't collapsing with a dramatic crash or a sudden headline-grabbing event. Instead, it's undergoing a slow, persistent shift that many homeowners can feel beneath their feet. Across the state, a growing number of owners are putting their homes up for sale, not because they're eager to lock in another massive gain, but because they're increasingly anxious about what the market could look like in 2026 if they wait too long. Inventory is climbing. Insurance costs are strangling household finances, and a new type of buyer is quietly stepping in to acquire what stressed families are being forced to leave behind. If you think Florida's real estate boom is still unstoppable, it's time to reconsider. Beneath the palm trees and pastel stucco facades, the Sunshine State is experiencing one of the most significant housing pivots in its recent history. In 2025 alone, the number of active listings statewide jumped from just over 102,000 homes to approximately 127,000, an increase of about 24%. That surge has rapidly flipped many local markets from aggressive bidding wars into environments where buyers suddenly hold the upper hand. At the same time, real estate professionals across Florida are witnessing behavior that used to be extremely rare. Sellers are pulling their homes off the market after realizing they can no longer demand peak prices, while others are cutting asking prices simply to stay ahead of the growing competition. This outcome was not what most people expected after more than a decade of relentless price appreciation. This deep dive reveals the forces driving Florida's quiet housing exodus. You'll see why thousands of homeowners are choosing to list now, why many of those sellers aren't just relocating nearby but leaving the state altogether, and how large institutional investors are steadily reshaping who will own Florida real estate in the next cycle. The central question is simple but harsh. Are today's sellers panicking too soon, or are they the only ones who recognize what 2026 could bring? Subscribe to our channel for data-driven real estate intelligence that cuts through hype and exposes what's really happening beneath the surface. In a market this volatile, information isn't just power, it's protection. The shifting ground, Florida's new inventory reality. To understand why so many Florida homeowners are considering selling before 2026, you have to begin with the most important metric in any housing cycle: inventory. During the pandemic boom, homes for sale in Florida fell to historic lows. Some metro areas had just weeks of supply, with buyers lining up on day one, often making all-cash offers well above asking prices. That era is over. By late 2025, statewide inventory had climbed to roughly 127,000 listings, up from just over 102,000 a year earlier. This increase has pushed months of supply toward levels that favor buyers rather than sellers. Market trackers like House Canary now describe Florida as facing a record-setting wave of inventory, especially in markets that were once red-hot and where construction continued long after cheap money demand faded. What makes this moment especially unusual isn't only the number of listings, it's when they're coming to market. Traditionally, many Florida homeowners waited until spring or early summer to sell, hoping to capture seasonal demand from snowbirds. In 2025, however, a noticeable spike in listings appeared immediately after hurricane season. Homeowners in coastal and low-lying areas decided they couldn't face another year of storm anxiety, rising premiums, and repair risks. Agents in Southwest Florida along the Space Coast and across parts of the Panhandle describe a pattern repeating itself. One more storm, one more insurance renewal notice, and then a call to a realtor the following week. On paper, many of these owners still have meaningful equity. Emotionally, they feel trapped. At the same time, inventory growth isn't uniform across the state. In land-constrained coastal neighborhoods with limited new construction, the market has cooled, but remains relatively competitive. Meanwhile, in growth corridors packed with new subdivisions and speculative builds, particularly on the outer edges of Tampa, Orlando, and Jacksonville, inventory has exploded. Days on market are lengthening, and builders are increasingly relying on incentives and quiet price reductions to keep sales moving. This uneven pattern is typical of the early stages of a housing correction. Some areas drift sideways, others quietly transform from sellers' markets into buyers' playgrounds, even as headlines continue to focus on median prices holding steady. If this level of granular breakdown is already revealing cracks you haven't seen elsewhere, subscribe to State Stories. This is the kind of analysis that helps prevent 6- or 7-figure mistakes. The insurance inferno, when ownership stops adding up. The strongest force behind Florida's silent exodus isn't home prices themselves, it's the cost of insuring those homes. Over the past several years, Florida's insurance market has been battered by repeated hurricanes, soaring reinsurance costs, and a legal environment that pushed multiple carriers into insolvency. Between 2022 and 2024, at least 6 property insurers failed or exited the state entirely, forcing hundreds of thousands of homeowners onto the state-backed Citizens Property Insurance Corporation or into expensive, last-resort coverage. The result has been staggering. Average home insurance premiums in Florida have surged to several times the national average. Many homeowners now open renewal notices showing increases of 30%, 50%, or even 100% compared to just a few years earlier. By mid-2025, regulators and industry groups began using the word stabilization. New laws aimed at curbing litigation abuse were in effect. A handful of insurers cautiously returned to the market, and some rate filings showed smaller increases than the jaw-dropping hikes of previous years. But stabilization doesn't mean affordability. It means the bleeding has slowed at a far higher baseline. Data from consumer insurance platforms and Florida-focused brokers show that premiums remain dramatically above national norms. In many coastal or flood-prone zip codes, annual insurance bills in the 5-figure range are no longer rare. They're becoming common. For retirees living on fixed incomes and families who stretched themselves thin during the pandemic buying frenzy, these costs are crushing. The human impact is severe. Inland counties that once represented affordable Florida for working-class households are now being hit almost as hard as coastal luxury markets. Reporting from Inside Climate News shows how premiums have surged in poorer inland communities even as wages stagnate. Some families report that their mortgage plus insurance now consumes well over half of their take-home pay, leaving little room for savings, repairs, or emergencies. Faced with impossible choices, dropping coverage, going uninsured, or selling, an increasing number of owners are choosing to cash out and leave. Some relocate to neighboring southern states. Others leave the region entirely. This is why traditional affordability metrics are failing. A buyer may technically qualify for a mortgage, but once insurance, taxes, and association fees are added, the monthly burden becomes suffocating. For longtime owners whose premiums doubled or tripled in just a few years, that pressure is translating directly into for-sale signs. Many aren't waiting to see whether the next renewal brings another 4-figure shock. Investor influx. Who's buying the fear? When everyday Floridians start quietly heading for the exits, someone else inevitably takes their place. Increasingly, that buyer isn't another family. It's an institution. Over the last decade, Florida has become one of the largest hubs in the country for institutional single-family rental investors, ranging from publicly traded REITs to private equity funds and operators focused on build-to-rent communities. A March 2024 single-family rental report identified Florida as a top target for this strategy, with firms aggressively acquiring homes in metros such as Tampa, Orlando, Jacksonville, and parts of Southwest Florida. According to Florida Realtors, corporate investors own at least 117,000 single-family homes statewide, with the true number likely higher once smaller entities and indirect holdings are included. In certain markets, institutional landlords control more than 10% of the rental housing stock, effectively converting entire subdivisions into professionally managed rental neighborhoods. For families trying to buy starter homes, that means competing not only with other buyers, but with funds capable of paying cash, waiving contingencies, and treating each property as another spreadsheet entry. By 2025, signs emerged that even these deep-pocketed investors were becoming more selective. Axios reported a dip in institutional purchases in early 2025, reflecting a national slowdown driven by higher financing costs and thinner margins. But a slowdown doesn't equal an exit. Many funds are simply pivoting, targeting distressed assets, bulk purchases from small landlords, and build-to-rent developments where costs can be controlled from day one. In this environment, homeowners forced to sell due to insurance or carrying costs increasingly find their strongest offers coming not from families, but from corporate buyers ready to convert personal dreams into long-term rentals. Over time, this shift has major consequences. As more homes move from owner-occupied to institutionally owned, communities risk losing stability and civic engagement. Homeowner associations report higher turnover, more absentee landlords, and increased friction over maintenance when out-of-state corporations control properties. For aspiring buyers, the quiet exit of current owners lays the groundwork for a future where owning a Florida home increasingly means renting from a fund rather than holding a deed. Is 2026 the new 2008? Whenever Florida's housing market wobbles, memories of 2008 resurface. Back then, the state was ground zero for the subprime collapse, with speculative condos, rampant flipping, skyrocketing foreclosures, and half-built subdivisions abandoned mid-construction. So is history repeating itself? The answer is more complex and more dangerous than a simple yes or no. On one hand, today's lending standards are far tighter. Most recent buyers documented income, made meaningful down payments, and locked in fixed-rate mortgages rather than risky teaser products. That means more real equity exists in the system, and fewer borrowers face immediate default if prices soften. On paper, that reduces the odds of a sudden foreclosure tsunami. On the other hand, Florida's affordability gap is extreme. Prices in many areas remain 30% or more above pre-pandemic levels, even after modest corrections, while incomes have lagged far behind. Add insurance premiums that have surged by tens of percent in just a few years, and mortgage rates that remain far above 2020-2021 lows, and the cost of ownership has outpaced what many local buyers can sustain. Investors can absorb some of that gap, but they aren't limitless. If the broader economy weakens or credit tightens further, institutional buyers will pull back too. Increasingly, analysts describe Florida's outlook not as a dramatic implosion, but as a slow-motion bust, a grinding crash where prices stagnate or drift downward over several years, falling much more sharply in real, inflation-adjusted terms. In this scenario, time on market stretches. Sellers face repeated price cuts. Heavily built outer suburbs, retirement-heavy coastal areas, and high-risk storm or flood zones suffer double-digit real declines, while more resilient urban cores tread water. Late sellers fare the worst. Early movers in 2025 and early 2026 may still preserve a meaningful portion of pandemic-era equity. Those who wait until financial stress forces a sale may find themselves listing into a crowded market where buyers expect discounts and investors smell opportunity. Looking ahead, how homeowners can navigate the uncertainty? For Florida homeowners, the decision is deeply personal. Sell now or hold on and hope. There's no universal answer, but several factors clearly matter. Start with carrying costs. If insurance, taxes, and maintenance are consuming a growing share of income and leaving little margin for savings or emergencies, that's a serious warning sign. Owners facing doubled or tripled premiums or looming hikes from re-rating or flood map changes must weigh emotional attachment against financial risk. Next, assess climate and regulatory exposure. Homes in frequently flooded areas, barrier islands, or regions with outdated building codes face higher risks of non-renewals or steep surcharges when reinsurance markets tighten again. Time horizon is also critical. Owners planning to stay for 15 or 20 years and who can comfortably absorb higher costs face different risks than those planning to move within 5 years or who bought speculatively. For shorter-term holders, the combination of flat or declining prices and persistently high insurance costs should prompt a serious evaluation of selling while buyer demand still exists. On the policy front, there is some hope. Florida lawmakers have enacted multiple rounds of insurance reform aimed at reducing litigation abuse and attracting capital. Early 2025 reports suggest these measures are beginning to stabilize parts of the market as new insurers enter and rate increases moderate. There's also speculation about further state or federal intervention, including expanded reinsurance backstops or targeted subsidies. But none of these options are guaranteed, and none are likely to return premiums to the ultra-low levels of a decade ago. Climate risk and reinsurance realities aren't disappearing. As 2026 approaches, the signals to watch are clear. Monitor active listings and months of supply. If inventory remains elevated or continues to rise, buyers will retain pricing power. Track insurance news closely. Carrier exits, insolvencies, and major rate filings often foreshadow regional stress. And watch investor behavior. A renewed buying surge could stabilize prices in some areas. A deeper retreat could accelerate corrections. With the right data, homeowners and buyers can make decisions grounded in reality rather than marketing slogans about endless sunshine. Some will choose to sell now to protect equity and peace of mind. Others will stay, accepting higher costs in exchange for long-term lifestyle value and confidence in their specific location. What matters most is making those choices with eyes wide open. If this breakdown helped you see beyond the headlines and understand the real forces reshaping Florida's housing market, hit like, subscribe to our channel for weekly data-driven insights, and leave a comment. Are you planning to sell, hold, or buy in Florida before 2026?